Welcome to vTalkInsight, Risk Sentiment Daily for December 29, 2025. Equities sit near record levels. AI and gold are both surging, and yet consumer and policy risks are building into an election-heavy calendar. Today we will unpack how those cross-currents are shaping risk appetite, where the market still looks comfortably risk-on, and where late-cycle stresses are starting to show. Across global markets, the tone remains cautiously risk-on, but with clear signs of fatigue. Global equities have logged strong double-digit gains this year, with one major world index up over 20% and on a multi-day winning streak, while the S&P 500 has notched dozens of new highs even as recent sessions have seen very modest, almost flat, moves. Volatility indices hover in the low teens, underscoring complacency rather than fear. Underneath that, the bullish narrative is still powerful. Fiscal stimulus, a weaker dollar, and earlier declines in oil prices are expected to support firm U.S. growth into 2026, while capital spending is projected to broaden beyond the early AI leaders as financial conditions ease. Analysts are talking about mid-teens earnings growth and double-digit S&P 500 upside next year, driven by both continued AI strength and wider sector participation, from banks to healthcare and industrials. Balancing that, late-cycle warning signs are becoming harder to ignore. Equity valuations are rich, spreads are tight, and several voices anticipate a meaningful correction or even a bear market window in 2026, especially given election and policy uncertainty. Safe haven demand is elevated, with gold, silver, and other precious metals at or near record highs, while consumer confidence is weakening and the labor market is showing more stress at the lower income end. Putting it together, sentiment is still skewed toward risk-taking, but investors are increasingly alert to downside scenarios. AI and earnings-led growth momentum remains the single strongest bullish force in today's backdrop. Chip leaders like NVIDIA and Micron report demand that continues to outstrip supply, with new product cycles such as Blackwell and Vera Rubin reinforcing expectations for sustained hardware spending. AI-native firms are scaling at unprecedented speeds, with one flagship platform reaching hundreds of millions of users and over 1 million business clients within just a few years, signaling a deep structural shift in technology adoption. This AI story is not just about semiconductors. Capital spending is expected to broaden beyond the initial AI winners next year, supported by easier financial conditions and multiple fiscal programs, making investment a key driver of U.S. growth. Corporate balance sheets are described as robust, with rising cash reserves enabling companies to fund capex and M&A, and strategists see earnings growth of roughly 15% as the main engine of equity returns, even more important than central bank moves. Banks, pharma, and automation-related businesses are all cited as beneficiaries of this capex and innovation cycle. For this AI and earnings-led momentum to keep supporting risk assets, several conditions have to hold. Investors are increasingly demanding evidence that AI spending translates into productivity and profit, not just higher capital intensity, particularly for hyperscalers and software vendors tied to enterprise budgets. There are also concerns about sector concentration and stretched AI valuations, with some pointing to asset sales by large investors and the prospect of volatile IPO repricings as signs that exuberance could overshoot fundamentals. If earnings keep delivering and productivity gains materialize, this remains a powerful tailwind. If not, the same AI theme could quickly shift from support to vulnerability. Another key support is monetary easing, liquidity, and disinflation tailwinds. The Federal Reserve's balance sheet has expanded again to maintain ample reserves, and markets expect a faster pace of rate cuts alongside increased fiscal stimulus, contributing to a steeper yield curve. That combination tends to lower borrowing costs over time, reduce the government's interest burden, and free up space for credit growth, all of which are typically constructive for risk assets. On inflation, the picture is mixed, but near-term signals lean supportive. Owner-equivalent rent, a large component of core consumer prices, is expected to trend lower in 2026, offering a meaningful disinflationary impulse. At the same time, the broad U.S. dollar index has already declined significantly this year and could slip further, aiding global liquidity and supporting commodities. Precious metals have rallied hard on expectations of easier policy and a weaker dollar, underlining the role of liquidity as a driver across asset classes. However, this supportive policy mix comes with important caveats. Inflation data are distorted by technical factors and unresolved tariff effects, and if price pressures surprise to the upside, there is judged to be more room for renewed hikes than for deeper cuts. Political pressure on the Fed, uncertainty over the next chair, and a divided committee all raise the risk of policy missteps that could jolt both rates and risk assets. The base case remains one of easier financial conditions and benign disinflation, but the path is far from guaranteed, which helps explain why investors continue to hedge with gold and other real assets. Alongside AI leaders, a gradual broadening of equity leadership beyond megacap tech is emerging as a constructive theme. Strategists expect next year's gains to come not only from AI-driven titans, but also from sectors such as healthcare, banks, and industrials, with cyclical areas poised to benefit if the economy avoids recession and policy rates drift lower. Recent market action already shows rotation away from the highest valuation tech names toward areas like metals, financials, and industrials, while defensive such as staples have lagged. This broadening trend extends beyond U.S. large caps. Small and mid-cap equities could see relief from a lower rate environment and increased merger activity, helping to close the performance gap versus mega-caps. Large U.S. banks have already outpaced smaller peers thanks to robust capital markets income, and a steep yield curve plus benign credit conditions are highlighted as supports for bank earnings. Pharmaceuticals have outperformed the broad index this quarter, driven by underappreciated pipelines and strong execution, adding another non-tech leadership pocket. For risk sentiment, this potential broadening matters in two ways. First, it reduces dependence on a narrow group of AI winners, addressing some of the concentration fears that have built over the past year. Second, it opens up more diversified sources of return across styles, sectors, and regions, from Nordic high yield to Japanese credit opportunities, which can help portfolios weather idiosyncratic shocks. That said, the process is still early, and if growth or policy disappoint, cyclicals and smaller caps could retrace quickly, pulling breadth back toward a more fragile, tech-heavy profile. Set against these supports, elevated valuations and correction risk form the dominant bearish narrative. Equity markets are trading at demanding multiples, with significant optimism already embedded in prices and spreads tight across credit. Several commentators argue that markets are not adequately pricing tail risks, pointing to stretched valuations in AI-related equities and credits, thin trading volumes at new index highs, and an environment where even modest disappointments could trigger outsized reactions. Signs of froth are visible in specific segments. AI-linked companies are flagged as potentially overvalued, with some high-profile investors selling strong-performing assets to fund further AI bets, raising questions about the sustainability of current pricing. Upcoming large AI and tech IPOs could inject further momentum, but also risk sharp valuation resets as private market expectations meet listed market discipline. In commodities, gold and silver have delivered their strongest rally in decades, with parabolic moves in silver and heavy exchange-traded inflows that could reverse abruptly, adding another layer of correction risk. Historically, mid-cycle and election years have seen sizable drawdowns, and today's setup fits that pattern of elevated starting valuations and low volatility. Some expect only moderate equity returns from here, while others explicitly project a significant correction or bear market window in 2026 after a period of nonlinear, liquidity-fueled gains. Consumer spending at the top end is also highly sensitive to asset prices, meaning a pullback in equities or housing could quickly feed back into earnings for premium retailers and discretionary names. Overall, valuation risk does not preclude further upside, but it narrows the margin for error and makes downside shocks more asymmetric. Policy, inflation, and election uncertainty form the second major cluster of downside risks. The upcoming decision on Fed leadership is a key focal point, with candidates perceived to differ on quantitative easing and balance sheet strategy. A divided Federal Reserve, with many members favoring cuts but others worried about inflation, raises the prospect of mixed messaging, a steeper curve, and bouts of volatility as markets reassess the path for short-term rates. Inflation itself is described as a wild card. Technical quirks in the data and unresolved tariff impacts make it harder to read underlying trends, and several observers stress that if inflation reaccelerates, the Fed has more scope to hike again than to deliver large additional cuts. At the same time, the U.S. tariff regime has become far more complex, with frequent code changes and the possibility of new levies or trade disputes linked to upcoming court decisions and renegotiations of key trade agreements. Those factors could raise input costs, tighten margins, and inject further uncertainty into corporate planning. The political calendar adds another layer. Historically, the second year of the U.S. presidential cycle has delivered below-average returns and above-average volatility, with bear markets often occurring or bottoming in that window. Midterm periods are associated with corrections in the mid-teens, and today's environment includes additional stress points such as trade tensions, sanctions in key commodity-producing regions, and regulatory shifts affecting sectors from pharmaceuticals to crypto. Together, these policy and election uncertainties increase the probability of regime shifts in volatility and leadership, even if the base case on growth and earnings remains constructive. The third key risk lies in consumer and labor market strain. Headline holiday sales data looks solid, with estimates of around 4 to 5% growth and total spending exceeding $1 trillion. But beneath the surface, the U.S. economy remains distinctly K-shaped. The top income quintile now accounts for the vast majority of consumption, supported by strong asset markets, while lower and middle-income households feel persistent cost of living pressure. Labor dynamics reinforce that divergence. Wage growth is slowing, especially for lower-income workers, and labor market softening is evident in a sharp rise in unemployment for some demographic groups. Consumer confidence has declined for several consecutive months, with worries about job security, tariffs, and stubborn inflation weighing on expectations for 2026. Signs of frugality are emerging, from increased focus on essentials to shifts toward discount and off-price retailers, even as overall spending has remained resilient into year-end. This tension between resilient aggregates and stressed households has important implications. High-income consumers are currently propping up discretionary categories through wealth effects from record equity markets, but a market pullback could quickly curb their spending, pressuring premium retail and travel. Meanwhile, lower-income households face a potential post-holiday hangover as higher credit card and buy-now-pay-later balances meet still elevated prices for everyday items like food, housing, and insurance. AI-driven investment and fiscal measures may offset some of these headwinds, yet the risk remains that consumer-driven growth looks less durable than headline GDP and earnings forecasts imply. To sum up, risk sentiment remains cautiously risk-on, powered by AI and earnings-led growth, a still supportive liquidity and disinflation backdrop, and early signs of broader equity leadership beyond the original mega-cap tech winners. Set against that are three increasingly important breaks on risk appetite: rich valuations and rising correction risk across equities and metals, a highly uncertain mix of policy, inflation and elections, and mounting evidence of strain in the consumer and labor backdrop beneath otherwise solid aggregates. Watching how these forces evolve, especially earnings delivery versus lofty expectations, the Fed's reaction to incoming inflation and trade data, and the behavior of high-income spenders if markets wobble, will be critical for framing scenarios into 2026. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.